When you walk past the neon pink arches of the Flamingo Las Vegas, you're looking at one of the oldest resorts on the Strip. Opened in 1946, built by a former mobster, reinvented countless times. It used to have swagger. Now it feels like a sinking ship in lipstick. And here is the kicker. Caesars Entertainment is reportedly orchestrating up to $500 million renovation plan for the Flamingo, or so the rumors go. Yet they refuse to pull the trigger. Not because they do not have the cash, because the math says the Flamingo may not be worth saving, at least not in the way you would expect. Let us back up. The Flamingo has always represented that exotic core of Vegas nostalgia. The palm trees, flamingos, the simplicity, but that simplicity is now exactly what hurts it. In a world of LED domes, ultra-luxury towers, high-limit salons, and influencer-driven nightclubs, the Flamingo stands out, but for the wrong reasons. It looks dated, it feels tired, and it is corner-positioned in the middle of the Strip with huge operational costs and shrinking foot traffic. So when you hear $500 million rescue, buy the headline, but question the logic. Why would Caesars pour $500 million into a property whose future is so murky? The first problem, location and tier. The Flamingo sits in a segment that has been hollowed out. The South Strip is booming with ultra luxury. The North Strip is remodeling itself for tech-driven resorts. That leaves the middle, where the Flamingo lives, caught. Guests who used to be high rollers now go to Wynn or Venetian. Budget travelers drive to downtown Las Vegas or off-strip. The Flamingo is too expensive to be valuable, too old to be luxury. When Caesars looks at the guest mix and sees shrinking returns, spending as much as $500 million becomes a liability. They know pouring money into towers, pools, floor revamps might not change the structural reality. Fewer visitors, lower spend, and a location that no longer drives premium demand. Then there is the cost side. A mid-strip resort like Flamingo is not built like newer mega resorts. It has legacy infrastructure, inefficient rooms, decades of renovations layered over renovations, HVAC units, elevators, and even plumbing carry 40-year-old bones. That means every dollar spent is eaten by catches and fixes rather than headline upgrades. Imagine spending $500 million only to fight endless deferred maintenance and outdated layouts. Even if Caesars built a brand new tower, they would still have to keep the old one running, with service disruptions, the legacy cost drag, and guest dissatisfaction. The risk to Caesars is not just cost, but revenue dilution. Caesars board and investors have to ask, what return do we get? If Flamingo averages $100 average daily rate and 80% occupancy after a $500 million refresh, just to get back to the same numbers, the return on investment is deeply questionable. Large resorts built new can spend $3 to $4 billion expecting modest returns. A $500 million injection may sound modest, but in Flamingo's case, that is almost a total rebuild in that context. Caesars must compare the opportunity cost of investing there versus building something entirely fresh somewhere else. So refusing to pull that $500 million means one thing. Caesars does not believe the risk-adjusted return makes sense. Add to that the distraction factor. The Vegas tourism model is changing fast. People are not coming for the old Vegas buffet and flame show. They are coming for immersive attractions, restaurants with global chefs, social media mangable experiences, and resorts that feel like destinations in themselves. The Flamingo's brand is nostalgic, yes, but nostalgia does not deliver high spenders or social virality. It delivers older guests, repeat visitors looking for deals, not the high roller or influencer jet set that money flows around nowadays. If you spend $500 million and the guest profile does not change, you have just printed a white elephant. Then there is the brand positioning inside Caesars. The company owns Caesars Palace, Harrah's, and other premium resorts. They have been pulling away from value remnants and doubling down on prestige. The Flamingo is the antithesis of prestige in today's Las Vegas. Renovating it might revitalize it, but it would also send the wrong signal to investors. We are pouring money into our oldest, weakest asset. No one wants that headline. So instead, Caesars appears to be standing on the sidelines, watching, waiting, maybe hoping someone else will rescue or redevelop it. Another factor is the competitive environment. Nearby newer hotels are pulling away guests. The Wynn Encore Complex, the upcoming Fontainebleau, the Sphere and Resorts World, they all shout next-gen Vegas. Meanwhile, the Flamingo's most talked about upgrade is new carpets and a brighter facade. That comparison crushes guest expectations. When millennials pick resorts based on Instagram or TikTok vibes, the Flamingo does not stand a chance. Caesars likely sees this gap and realizes even $500 million will not reposition the Flamingo into the top tier. It might just keep it alive. And let us not forget opportunity cost beyond real estate. Caesars could spend $500 million on several smaller properties, or on acquisitions of gaming assets elsewhere, or on tech upgrades chain-wide. The decision not to invest is not just about Flamingo, it is about strategy. They are choosing where to allocate capital where they believe returns are higher. By not committing to Flamingo, they are signaling to the market they are done pushing value segment resorts like this. Focus will shift up market. The Flamingo may be sacrificed. One of the most telling signs: staff and union discussions. According to insiders, Flamingo's maintenance staff have been told to wind down non-essential refurbishments and focus on operational stability instead. That is corporate code for do not invest heavily here. When the company is publicly trimming expectations rather than promising investment, it means the asset is being managed for decline rather than growth. A $500 million commitment would flip that script. So what is the future for Flamingo? A few scenarios: full redevelopment into a mixed-use tower, hotel plus condos, a partial demolition replacing old towers, or complete shutdown and sale of land. For Caesars, that is less scary than a half-finished renovation that ends up with the same guest volume and the same low spend. They would rather sell than try to reinvent. The refusal to invest is a clue to what they believe. Flamingo is not broken, it is broken beyond what reinvestment can fix. The lesson for Las Vegas: even a heritage resort with name recognition and legacy value can become a liability if the model shifts beneath it. Caesars may own the land, the brand, the shells, but if the guests do not come back, what is the point? Flamingo stands as a monument to the era when volume mattered more than nuance. Today's nuance rules. If Caesars will not pay $500 million to save it, you can bet they already wrote it off.